Broo is one of only a handful of breweries listed on the Australian Stock Exchange. It trades under the ticker BEE and has an enterprise value of about $200 million. It was only listed 2 months ago and its share price has since risen 70% from 20 cents to 34 cents, which is higher than the 6 cent valuation on Shareclarity. Broo is still an early stage beer producer that does not own its own brewery or bottling plants. It essentially owns the Broo and Australian draft beer brands. These have been externally brewed and bottled by the Icon Brewing Company in Australia since 2009 and the Ginseng Beer Company in China since 2014. Broo uses an in-house sales team to market and distribute its beers in Australia and 2 third-party sales agents to distribute its beers in China. Broo only generated $500,000 in revenues last year and it is expected to remain cash flow negative for a few years yet. When I went through the valuation on Shareclarity, I was most interested in what would need to be true to justify its current share price. The forecasts see Broo's revenues growing from $500,000 to $20 million in the next 3 years, and its EBITDA margin eventually growing from negative to 18%, which is similar to other companies like Gage Roads Brewery and Moa, even though they are more vertically integrated and operate within the higher margin craft beer market. The forecasts also don't contemplate any capital investment in an internal brewery or bottling plant, which therefore suggests that its revenue growth is a key determinant of value. I played around with this profile and saw that, all else being the same, it would need to grow revenues from $500,000 to $100 million within the next 3 years to justify its share price. Ordinarily, this would appear rather aggressive, but in a country the size of China it certainly is possible. So we'll be keeping a close eye over the next few reporting seasons to see if its demand and distribution models start to gain traction and how well the business adapts to any such growth.